So, hello guys. Hope everybody's having a great day wherever you are, whatever you may be doing. Here we go for another one of these Substack videos. No trade calls, no recommendations, every response for their own stuff. We're here for educational purposes only. So, we're looking at ES, right? A couple of people wrote in, so I thought we'd do a quick update here. So, basically, we're still in this upside grind, right? Sky's the limit, continuing to press towards these primary targets of that rotation off those lows in April. And just as a reminder, we've got two sets of areas we're looking at. Of course, people are going to talk about the psychological 7,000 mark but for technical purposes, we're talking at primary targets back in here, depending on how you're looking at the targets, but it's inside, 6780s, 6850s in terms of primary target, and then extension targets higher up into that 7,200, 7,500 range. And as long as we keep on taking out those new highs, that's the limit. That sky's the limit. That's the pain trade is continuation higher. Now here, in terms of seasonals and in terms of location, it's not uncommon to see a little bit of an unclench after quarterly expiration, especially the June and the September ones. So right here, again, I think the pain trade is higher because both the longs and the shorts are probably thinking, most often than not, we should see a little bit of a heavy flow here, a little bit of a pullback. And a lot of people will be quoting stats that the week after, quarterly expiry tends to be red. Now, so here, I think, again, instead of trying to make it more complicated than it should be, just keep it very, very simple. As long as we go into these days with low volume chop, sideways action, your base case assumption has to be sideways to up drift. The market always has, a tendency, an upside bias, and especially in thin liquidity, in the absence of headlines, or even if Trump or the admin is trying to pump stuff, your base case assumption is going to have an easier time trying to continue to rotate higher. So there's really zero edge in trying to take out, trying to short any new highs or any slow chop grind higher. Now, however, if we hold the highs from last week, also because the high was set in RTH, right, you'd expect to have a decent chance of some downside follow through. Okay, that's would be the focus to the downside. So here, what I would say is, to the downside, remember that any correction back into this 10-day moving average is also going to be protecting the FOMC range low, right? That's that FOMC range low. So I think here, any move back into the 10-day, into that FOMC range is just a little bit of a healthy post quad witching action, and you shouldn't read too much into it. Clearly, it's a tradable move, but you shouldn't be reading it too much into it. Now, if we get a day close below that FOMC range low, and that would mean also it's below the 10-day moving average, then my base case assumption is that we're seeing a little bit more of a pullback, and we'll be coming back towards the 50-day moving average, this whole series of previous highs, and there's a lot of confluence around this level. But even here, this level should get bought aggressively, and it's still, broadly speaking, fairly neutral. Now, if we take that out this week, call it 6,500, just to talk round numbers and make it a little bit easier. If you take out that 6,500 from a closing basis, then I would not be surprised for us to try and come back into these previous highs and to unwind the whole of the yearly gains, and that's talking about 6,000. So I think here, really, those are the big levels you have to watch in terms of huge pivotal zones. I think those are above the primary target. That really opens up blow off top squeezy action. And if you ever get acceleration through the 200 DMA, through these previous highs, through the 2025 open, then that becomes a very significant turn point. But anything that keeps on hovering inside this broader area is just, fairly technical and tradable in the context of an upside rotation. And again, a move back into these into that 50-day moving average off those highs we set last week in RTH is probably just like a 3 to 5% move, so that's fairly common. You'd expect to see that every couple of months or so, maybe a little bit more, that kind of correction. And even if we do come all the way back down, that's a 10% correction. You'd expect to see an awful lot of buying, not only people already trying to buy micro corrections into the 10-day, but you'd expect 5% down, you'll see people putting money to work, and 10% down, you'll see a lot of money being put to work. So I think you'd have to really have a disaster situation for us to accelerate below that. But right now, what we have is some tradable downside Momo if the market is going to behave in a textbook manner this week, setting up into that post expiration week into the end of the month. And then that takes us into Q3, and everybody's going to be looking for a tradable low for that, year-end rally. But that's what I would be looking at. And I think in terms, again, the short-term reference points to watch is Friday's high to block or stall or accelerate that grind higher, and the FOMC day low to open up a little bit more downside. Okay, that's what I'm looking for. Wishing everybody an awesome week ahead. All the best. Take care, guys. Bye-bye.